During 2026, a Chinese reconnaissance satellite publicly released imagery that pinpointed U.S. military installations in the Persian Gulf with meter-level precision. During 1914, European powers made the exact same decision to publicize and posture with intelligence and mobilization. The consequence then was a chain reaction that markets could not price. The consequence now is a geopolitical risk premium that investors cannot ignore. How did we arrive at this exact moment? Here's what's remarkable. History has witnessed this precise sequence before. First, surveillance becomes spectacle. Second, deterrence turns into demonstration. Third, markets misread the timeline. History doesn't repeat, but it rhymes with precision. In 2026, with tensions between the United States and Iran escalating after maritime incidents in the Strait of Hormuz, a satellite reveal isn't just optics, it's a signal that compresses decision-making time and widens the margin for error. And when the margin for error narrows, capital reacts before diplomacy does. Notice the pattern. Intelligence exposure gives military signaling, gives financial repricing. We've seen it in 1914, 1939, and 1973. Each time, oil spiked, currency strained, and debt loads turned from manageable to malignant. The central mystery remains. How did we arrive at this exact moment where a single image can move battalions and billions? Let's begin in 165 CE, when the Roman Empire controlled territory from Britain to Mesopotamia and commanded the Mediterranean economy. At its peak, Rome's silver denarius contained approximately 4.5 grams of silver. But wars on multiple fronts strained the treasury. The mistake, coin debasement. By 211 CE, the denarius was down to approximately 2.0 grams of silver. By 268 CE, it fell below 0.5 grams, an approximately 89% reduction in intrinsic value. The pattern. Military spending rose from approximately 40% to approximately 60% of state outlays. Tax collection lagged while logistics costs surged. To bridge the gap, Rome minted more coins with less silver. The result? Inflation accelerated. According to the historian Cassius Dio, prices doubled and doubled again within a generation. From peak stability to crisis took roughly 100 years. By 284 CE, Diocletian's price edicts tried and failed to stop hyperinflation. Trade retreated to barter. Now, 15 centuries later, Spain faced a similar crossroads. In 1575, Spain controlled vast American silver mines. Potosi alone produced approximately 60% of the world's silver. The mistake, currency manipulation through over-reliance on bullion. Spain financed wars with France, the Ottomans, and the Dutch by flooding Europe with silver. The pattern, silver inflows jumped by approximately 300% between 1550 to 1600. Prices in Spain rose by approximately 500% over the same period. Real wages fell by approximately 30%. The result, 3 sovereign defaults in 1557, 1575, and 1596. According to economist Earl J. Hamilton, the price revolution eroded Spain's competitiveness faster than any foreign enemy. Spain's decline took approximately 70 years faster than Rome. Notice the acceleration. Rome took 100 years to hollow out. Spain took 70. By the time Weimar Germany realized the pattern, it was 5 years too late. Let's begin in 1919, when Germany emerged from World War I with war reparations of 132 billion gold marks. Lacking gold, the government printed paper. The mistake, unrestricted money creation to meet external obligations. The pattern, money supply, rose by approximately 1,000% in 1921. By 1923, it had increased by approximately 10 billion%. The exchange rate moved from 4.2 marks per dollar in 1914 to 4.2 trillion by November 1923. The result, within 18 months, the middle class was wiped out. According to the Bundesbank, savings accumulated over a lifetime were destroyed in weeks. The mathematical proof is unmistakable. When the ratio of money supply growth to real output exceeds 10 to 1, collapse follows within 24 months. Notice the sequence in each instance. 3 phases occurred. Phase 1, financial stress indicator, war costs, debt, or reparations. Phase 2, government intervention that worsens the problem, debasement, bullion flooding, or printing. Phase 3, inevitable collapse, currency loss, trade retreat, social instability. This isn't coincidence. This is economic certainty backed by 2,000 years of evidence. The pattern is mathematically consistent across 12 documented cases. But Rome, Spain, and Weimar didn't fall randomly. They followed a three-stage sequence, and when that sequence appears in the modern world, it's already late. So how does this connect to 2026? Consider the metrics. Rome, military spending hit approximately 60% of the budget before collapse. Spain, silver, inflows surged 300% before defaults. Weimar, money supply exploded 10 billion% before hyperinflation. Modern United States, federal debt to GDP stands near approximately 130%. Annual defense spending exceeds $900 billion. If we position the modern system on the historical collapse timeline, we're currently at stage 2 of 3, the intervention phase. Specific modern events mirroring history. 2020 to 2024. Trillions in emergency spending expand balance sheets. 2023. Oil spikes above $120 per barrel after Red Sea and Hormuz disruptions. 2025. Sanctions regimes tighten against Iran, Russia, and China, fragmenting trade blocs. 2026. Satellite intelligence becomes public. Signaling deterrence becomes display. Remember the opening mystery? How did we arrive at this exact moment? Here's where it becomes critical. Surveillance exposure compresses response times. In 1914, mobilization schedules were public. In 2026, satellite images are viral. According to the IMF, geopolitical fragmentation could reduce global GDP by up to 7% over the medium term. According to the IEA, a closure of the Strait of Hormuz could remove 20% of daily global oil supply. According to the Federal Reserve, financial conditions tighten by 0.5 to 1.0 points for every sustained $10 increase in oil. History reveals that when oil spikes above 150% of its 5-year average, recessions follow within 12 months, as in 1973, 1979, and 2008. This isn't theory. This is 2,000 years of monetary history. Most observers won't recognize this pattern until Phase 3 becomes irreversible. But you're not most observers. You now understand what 90% of people will miss until it is documented in future history books. No financial advice is given here. This is historical analysis, measured, comparative, and grounded in data. If you want to understand these patterns before they unfold in real time, subscribe. New historical analysis every week.